Hello everyone, this is Dr. Zhao at MTSU. In this video, I will show you how we can use very different option strategies to achieve our investment goals, and especially the option strategies that we can utilize to assist our portfolio management and the risk management as well. So essentially speaking, there are many ways investor can utilize option to bet on increase or decline of our stock prices, right? And a very basic strategy is that, okay, if you expect that stock price will increase in the future, to maximize the gain, you can use a call option, right? Because call option will give you the difference between future stock price and the current stock price as your potential gain, but you invest much less in option than investing in stock, and call option give you the leverage in betting on increasing stock prices. By the same token, you can utilize put option to bet on stock price to decline without make a full investment in a stock. Let's say you can build a short position if you expect stock price will decline, but short position is very risky. In the future, you may lose unlimited amount of money, right? Your potential lose could be an infinite number when stock price increase dramatically in the future, right? And short selling is very risky. In this case, you might want to consider use put option to bet on stock price decline, because in the future, when stock price declines, your put option will generate gains. But when stock price increase indefinitely, then the maximum loss it may generate for your put option just the price that you pay the put option. So put option can actually put a limit on how much money that you can lose in short positions. But anyway, both both call and put option can allow you to bet on the direction of the stock price in the future. In this case, we use option for speculation purposes. Right? And here we have 4 very simple strategies to bet on stock price changes. If you are betting on stock price to increase, then you can take a long position in a call option. And this position can generate unlimited amount of gain, depending on how high the stock price will go. But it put a limitation on how much money that you can lose based on this bet, because the maximum loss is just the price that you pay for that option cannot go further than that. Right? So in this case, it has an advantage compared to investing a stock, because when stock price decline, it may decline to 0. But if you buy call option, the maximum loss just the call option value, which is a very small percentage of the stock price. So this long call option position has an advantage when you use it for speculation. Right? First of all, you have a leverage. Second, you have a limitation on how much money that you can lose. Alternatively, to bet on stock price increase, you can take a shorter position on the put option, or you can sell put option by betting on stock price to increase. So in the future, when stock price increase, there will be no payoff on the put option, but when you sell put option, you get a premium that you collect from your counterparties. That is another strategy to bet on stock price to increase. Meanwhile, you can use both call and put option to bet on stock price to decline. If you expect that stock price will crash in the future, what can you do? Well, simple way is buy put option. Put option will give you gain when stock price declines. When stock price increase, then the maximum loss is the premium that you pay on the put option. And alternatively, you can sell call option. To bet on stock price to decline. Right? Stock price to decline. And when you sell call option, when stock price declines, what will happen? What will happen? Well, in this case, you may face unlimited losses. You may face unlimited losses. But when stock price increase, then you can take the premium that you collect from your counterparties. Right? But take short position in call option is a very risky position because investor need to face unlimited amount of losses. It's a very risky position when investors are selling a call option. Other than speculation on the direction of stock prices, investors can also use combination strategies. The combination of many call and put options to bet on the volatility or bet on the risk. So let me use a very simple example to see how we can use this type of strategy. Right, let's say you are considering investing in a pharmaceutical company, and this pharmaceutical company has a very promising drug that is going through the FDA approval process, and the company will announce the results of FDA approval or disapproval next day. So there's two potential scenarios. If their new drug is approved by FDA, then stock price will spike, maybe by 30, 50, or even 100%. But when the drug is failed through this FDA approval process, you know that stock price will tank. Maybe it will decline by 30, 50%. So here, you have two very volatile scenarios in the future, or just for tomorrow, and you wanted to make investment on this risky pharmaceutical company. All right. So typically speaking, you have to know the direction to make money. Right? If you know very sure that the drug will be approved by FDA, then you should take long position. Right? And if you know that this drug's definitely going to fail the approval process, then you need to take short position. But at this moment, you don't know. Just you know that the results will be revealed tomorrow. Either it will go through it or it will fail. But two scenarios will generate very, very different payoffs. It's a very risky scenario. So in this case, how can you make money as an investor if you don't know the direction at all? Right? And a very traditional strategy will not allow you to make secure gain, but a combination strategy by using a combination of options can achieve that goal. Right? So essentially speaking, what you are sure about today is there will be tremendous volatility tomorrow. Although you don't know the direction, but that's all you need to know to make money. How? You can use combination strategy. Betting on the high volatility, right? And if high volatility is something that you are very sure about, then the combination strategy will generate tremendous amount of gain. And here you have three alternative strategies to utilize to bet on high volatility. Let's say for this pharmaceutical company, which is going through FDA drug approval process, and the results will be announced tomorrow. Either successful or be a huge failure. Right? But either way, it's a huge volatility, and to capture the high volatility, you can do one of those three strategies: a short position in butterfly strategy, a long position straddle strategy, or long strangle strategy. Let me explain a little bit on the three different strategies. A short butterfly strategist will ask you to sell a call option with a low strike price, sell one call option with a high strike price, and buy two calls with strike price in between. So here you buy, sell 4 call options, right? And actually the proceed will cancel out, because when you sell call option, you have money going to your account, but when you buy call options, money will go up, but the amount will cancel off each other, and that is a short position butterfly strategy. And this short position butterfly strategy will generate positive amount of gain when the market going through high volatility. But when market didn't go through any volatility, then you will lose. Then you will lose certain amount of money. That is the money that you spent in buying and selling call options. That is a short butterfly strategy. And the long straddle strategy asks you to buy both a call option and a put option with the same strike price. So in this case, your gain will be maximized when stock price either increase a lot or decline a lot. Right? And the only scenario you will lose money is stock price doesn't change a lot. In that case, you will lose the premium on both call and put option. Alternatively, you can do long strangle strategies. You can buy call option, put option with a different strike price depending on how bullish you are or how bearish you are. And here, your gain on the upper side and the downside is different. Just that this strategy will also generate net losses when stock price doesn't move a lot. So you can use a combination strategy to bet on the volatility of a stock or the market. And also you can bet on low volatility, use the long butterfly strategy or short strangle strategy or short straddle strategy. Follow the same mechanism, just on the opposite direction. So here, option give you a very powerful tool, which allow you not only betting on the direction of the security, but also the volatility of the security. Now let's look at a very sad story about a hedge fund which focused on the derivative trading back to 1998. That is long-term capital management, right? And previously we call people who utilize quantitative methods in financial derivative trading, especially options, as quants, and those are quantitative traders. And typically they do arbitrage. Right? And it's been very popular since beginning of 1990s, but in 1997 and 1998, due to the failure of long-term capital management, the popularity of quants was diminishing. However, after 1998, we have a rise of a new generation of quantitative traders. And here are a short list of the famous quants and the hedge fund that they're managing. For example, the number one quant and company is James Simon, Dr. James Simons, and his company called Renaissance Technology. And on the short list, you also see various famous hedge fund managers such as Paul Tudor Jones, Nicholas Moyes, Steve Cohen, and their companies like Amaranth Advisors and AC Capitals. And some of those companies were very successful, but other companies may not be that successful. Let me show you the number one investor on today's market. It's not Warren Buffett. It's not George Soros. It's Dr. James Simons. And Dr. James Simons is a mathematician. He worked for university many years ago. And somehow he figured out how to utilize his expertise in mathematics. And actually his expertise is the application of geometric measurement. And he figured out how to flex his mathematical muscle on this financial market. And he established a company called Renaissance Technology Company. It doesn't look like a financial company, but this company does all kind of financial arbitrage around the globe. And the strategy that this company utilizes is computer-based model. Right? And those models are quantitative model based on dynamic hedging mechanism, where allow investors to capture those arbitrage opportunities around the globe. Right? And his company is very interesting. First of all, the name doesn't look like a financial company, and also people he hired are not finance people at all. Dr. James Simons only hire non-finance people. Non-finance people. He hired PhDs in physics, in mathematics, in engineering, and he hired people who's really good at statistics and C++, programming language, so on and so forth. But he never hired any finance people. But those so-called quants did really good job in capturing those arbitrage opportunities around the globe, and his fund actually delivers tremendous amount of return for their investors. Dr. Simons, as the owner of Renaissance Company, make a huge amount of return for himself. Back to year 2008, he made 2.5 million US dollars. I mean, remember what happened in year 2008. In year 2008, financial crisis hit the market, and a lot of investment bank went to bankrupt, and the entire market was in chaotic situation. But Dr. Simons made 2.5 billion US dollars. 2.8 billion in year 2007, 1.7 billion in year 2006, so on and so forth. So basically, each every year he makes more than 1 billion US dollars for himself, right? Based on performance of Renaissance Technology Company, and Dr. Simon is truly number one. He's better than other well-known hedge fund managers such as George Soros, Louis Bacon, Mark Kingdon, Warren Trump, so on and so forth. He is truly number one, right? And his success allowed him to retire early, and he basically retired in year 2011. And what he does right now is to promote the elementary education, especially elementary education in mathematics, across the United States. And we know that in the United States, elementary teachers do not make a lot of money, and we do really have a very weak foundation in our elementary mathematics education. So what Dr. Simons does each every day now, right now, is donate a lot of his money into a lot of math education programs around the U.S., trying to promote high education of mathematics on the elementary school level. So this is a very successful story of Dr. James Simons and his company Renaissance Technology. Well, we have many successful quants, and we also have some not so successful examples. And here, the example is for of a well-known hedge fund called Amaranth Advisor in year 2006. In year 2006, September of year 2006, this company lost nearly 7 billion US dollars in just a couple of weeks, and it was forced to be liquidated. In this case, nobody bailed out this hedge fund, and just the gold went away. And this fund had over $9 billion under management in year 2006, and this fund was very successful in spread trade of natural gas market. And year 2005 was one of the most successful year for the company, and the strategy that it utilized is a typical quantitative trading model based on futures market, and they use 8-to-1 leverage, and they bet on the difference between March and April futures price of natural gas for year 2007 and the year 2008 will be greater because they have quantitative model to predict the spread between those two futures prices. But the spread actually went from $2.50 at the end of August year 2006 to less than 60 cents by end of September. So their bet actually went bad, which resulted in loss of 6.5 billion US dollars for that single month, and the company was forced to be liquidated. And Brent Hanna, who's a Canadian trader, worked for the company, and both Brent and the owner of the company, Nicholas, lost their job. So there was some unsuccessful cases in terms of quantitative trading. Now let's take a look at so-called delta hedge and a gamma hedge regarding option trading strategy, and those two hedging strategies are based on dynamic hedging mechanism, and essentially we want to set up a risk-free portfolio that contains both stock position and call option positions. And we can go two different ways. First way is to take long position in stock. In that case, to cancel off the risk in stock, we take short position call option. So it's a combination of long stock position and a short position in call option. Or we can do the opposite. We can take short position in stock and long position in call option. Just that in order to make this portfolio a dynamically hedging one, we need to constantly maintain its hedge ratio. As we know, this hedge ratio equals so-called delta or ND1 in call option pricing model, and this ND1 is a probability measure. And the problem with this hedge ratio is that this hedge ratio changes all the time. It changes all the. It's a dynamic term. It's a dynamic term. So you can calculate the hedge ratio at the very beginning and build a portfolio. In this case, we are building a delta hedge portfolio. However, this hedge ratio changes dynamically. In order to make your portfolio a dynamically hedged one, or the one that has zero risk, when other variables changes, then we have to follow so-called gamma hedge strategy. And a gamma hedge strategy consider the ever-changing nature of the delta, and it will adjust the structure of portfolio based on the dynamics of delta. How to capture the dynamics of delta? I mean, the key here is to take the second derivative, and that second derivative of the sensitivity of stop price against option price against stop price is called gamma. So delta is the first is a first degree derivation of that sensitivity, and the gamma is second level of deviation. It's called delta hedge and gamma hedge. Now let's take a look at how you can use options to assist your portfolio management. And on the market, people do use options for speculation purposes, either speculate on stock price or speculate on volatility. But the most common way that investors, especially those large institutional investors such as mutual funds, they frequently use options for portfolio management purposes. They use options not to bet on stock price increase or decline. They do not use option to bet increasing or declining volatility. They use option as insurance. Right? And on the market, the best insurance you can get for your stock portfolio is put option. So let's say you have a portfolio of many stocks, and right now you're happy with the performance of the portfolio that you achieved so far this year, but you have a concern on future market decline, right? And but you don't want to sell all your stocks because of the fear stock market decline, because your forecast may not be 100% correct. If you sell your stocks, then in the future, what if stock price increases, right? And I mean, in case stock price declines, you can avoid losses. But what if stock price increases? In that case, you will miss potential gains, right? And so here, the idea here is you hold your portfolio to enjoy future potential gain, but you just want to buy in an insurance for your portfolio in case stock market decline. And here, the insurance is a put option. So buying put option on the financial market is pretty much like buying an insurance. Right? Buying an insurance for your equity portfolio. You spend some extra money to buy insurance, right? So your premium pay for put option will not go wasteful, because in case stock market declines, your put option will generate positive returns to offset the losses in your equity portfolio. In the case your portfolio is protected when market declines. Right, you see? But when market increases, what will happen? Your portfolio value will continue to increase. You can still enjoy the potential increase in stock prices, just that those gains need to be offset a little bit by the money that you pay for this insurance. So this strategy that combines your equity portfolio and the put option and the insurance is called protective put. A protective put. The put option here is used for protection of your stock portfolio. This is the most popular strategies that mutual fund use on a daily basis for their portfolio management. And the second strategy is covered call strategy. Covered call strategy, as we learn that when investors sell a call option, it's very risky. It's very risky. I mean, in the best scenario, you take the option premium as your revenue, but in the worst scenario, you need to deal with unlimited amount of losses, because when stock price increases, there's no limitation on how much money you can lose. In that case, your call writing position or your call selling position is naked. It's not well protected. It's very vulnerable to future stock price increase. So the call option without, selling call option without any protection is called a naked call position. It's a very risky position. Right? But here, from call writer's position, they can add the safety net for their call writing practice, and the safety net here is the stock or stock portfolio that come with the call option selling position, right? So when you combine your short position on the call option and certain amount of stock or stock portfolio, then your call option is protected or covered. Why? Because in the future, when stock price increase, your call option will suffer from losses, but that loss can be compensated by increased value in your equity portfolio. You see that? It's covered, it's protected. So on the market, when a lot of investors are selling options, it's very likely they will add position of stocks or position of stock portfolio as a safety net. And a covered call strategy works the best when market doesn't move a lot. In that case, the value of your stock portfolio stay the same, and you take the call option premium. So covered call strategy is a very nice way for mutual fund managers to make some actual revenue when they forecast that the market will go through low volatility in the future. They have stock portfolio, let's say, in the future. Stock price won't increase a lot, but also it won't decline a lot, so it's kind of boring situation to hold their portfolio. But in this case, if they can issue call options, they can make money by collecting premiums from their counterparties without taking any risk when stock price increase a lot or decline a lot. Because even when stock price increase a lot, the call option is and the short position in the call option is well protected by their stock holdings. So this is so-called a covered call strategy, and it's a very popular strategy among mutual fund managers. They can make actual return based on their stock portfolio holding, and the actual return is selling call option. It's like taking the rent from their portfolio holding. The third strategy I want you to look at is protective call strategy, and this strategy is getting more and more popular among a lot of hedge fund managers. And typical practice that hedge fund manager does is to do a lot of short selling. As we know, that short selling is very risky, because short sellers are facing unlimited amount of losses when stock price increase a lot in the future, right? So in case stock price decline, that's good. But what if stock price increase? That is very dangerous for short position holders, and their position is very risky when stock price increases. So in order to neutralize risk when stock price increases, investor can buy call options. They can buy call options to offset the risk when stock price increase a lot. So when you combine a call option and your short position in certain stocks, your short position is protected. It's protected because in the future when stock price increase a lot, your short position will generate a huge amount of losses, but that amount of loss can be offset by the gain that you get from call option. Right? So when you combine a call option and a short position in stock, you are practicing so-called a protective cost strategy, and this protective cost strategy protects your portfolio from stock price increase when you are short selling it. Right? So on the market, people say, generally speaking, when a lot of people are buying call option, is a bullish sign, right? It makes sense because when a lot of people buy a call option, they might betting on stock price to increase. The more people are doing that, indicating that stock price may increase. But nowadays, when you see sudden spike in call option buying, that doesn't necessarily mean stock price is going to go up. It may indicate that a lot investors are buying call option as part of their short selling position, protected short selling position. Right? The more call option buying means bigger position on the short side. So investors need to be very careful in interpreting the trading activity on the call option market. The spike of call option trading doesn't necessarily mean there's a bullish trend in the stock. Instead, it may indicate there might be a huge or massive position on the short side, and yeah, that's a protective call strategy. Right? Now let's spend a little time look at the homework. Homework 4. Question number 1 to 20 something futures contract related questions. Now let's take a look at option related questions. Number 28. If Black-Scholes formula is solved to find the standard deviation consistent with current market call premium, that standard deviation would be called implied volatility. Right? The volatility that is implied by the option price that we can observe in the market. Second, what is the difference between actual call price and intrinsic value? Wow, that's too easy. The time value. Intrinsic value plus time value equals call option price. Number 30, all else equal, call option value are higher or lower if stock price, exercise price, dividend, stock volatility is lower. As I said, everything is positive, right? Call option price option price would be lower if something is lower, right? And the only opposite is the strike price or the exercise price. So the answer is B. Call option value is higher when exercise price is lower. It's opposite direction, right? And if stock price is lower, then option price should be lower. So it's not correct. Dividend payout is lower, then call option price should be higher, right? And the last one, stock price volatility lower, of course, call option price will be lower. So the best answer is B. Number 31, Black-Scholes option pricing formula was developed for American European option. Of course, it's for European option. Cannot tackle American option problems. Only binomial tree can deal with American option. Number 32, the hedge ratio is often called the options delta. Right? That's the first derivative of stock price versus option price. And the second derivative is gamma. It's gamma. But here the hedge ratio is called the delta. Number 33. Investor A bought a call option, B bought a put option, or else equal if underlying stock price volatility increases, the value of investor A's position will increase, and the value of investor B's option position will increase or decrease. Right? So A buy a call option, which is a bullish position. B buy a put option, that's a bearish position. Right? And if volatility increases, call option value will increase, and the put option value will increase because the volatility has positive relationship with both call and put options. So it's increase and increase. A. Number 34. The value of a call option increase with all of the following except stock price, time to maturity, volatility, and dividend yield is not. So D is the best answer for number 34. Number 35. The value of put option increases with all of the following except. Right? With all of the following except stock price. So A is the best answer. Right? For call option, that is strike price or exercise price. But for put option, it is stock price, right? Which has a negative relationship with the put option price. Number 36, perfect dynamic hedging requires, continuous balancing because that hedge ratio changes all the time. It requires continuous, constant rebalancing of the portfolio to achieve dynamic hedging. Number 37, the delta of an option is what? Well, the delta actually the probability of ND1, and actually it measures the sensitivity of option price versus stock price change, and here is the best answer. Number 38. According to Black-Scholes option pricing formula, two options on the same stock, but with different exercise price, should always have the same what? Implied volatility. Implied volatility, because this volatility is unique for one company, no matter what exercise prices are. So one company should have the unique implied volatility. C. For number 38. For number 39, the practice of using option or dynamic hedging strategies to provide protection against investment losses while maintaining upside potential is called what? Protection against investment losses while maintaining upside protection. That is a typical protective call strategy or portfolio insurance. Because your potential your potential losses in your stock portfolio can be issued by your put option position. That's portfolio insurance or protective put. Number 40. The stock price of a company is $100. In the future, it might either be 160 or 60 with the equal probability. Interest rate is 6%, and used binomial option pricing model. The value of put option with the exercise price of $135 and expiration date 1 year from now should be equal to what? Well, here first of all you need to figure out the hedge ratio by following the equation that you see in the lecture notes, and and here you see how to calculate hedge ratio, and hedge ratio is negative 0.75, right? And then you apply the hedge ratio into calculation of option price to get $38.21. So look at the textbook to see the detail of solving a typical option price based on binomial tree, and answer C for this question. Number 41. If you have an extremely bullish outlook on the stock market, you could attempt to maximize the rate of return by doing what? Bullish. So you buy call option. Right? So you have A, C, D, all buy call option. Right? It's just that you wanted to achieve maximum amount of return, which means you want to achieve maximum amount of leverage. What kind of option can allow you to achieve maximum leverage? Well, it is out of the money call option will allow you to achieve the maximum leverage of leverage. A is best answer. Number 42. You found option price for three June call option on the same stock. 95 means the exercise price of $95. Has a implied volatility of 25%, and 100 call has implied volatility 25%, and 105 call has implied volatility of 30%. If you believe this represents mispricing solution, you may want to do what? And here you have 3 call options on the same stock, and 3 options should have the exact same implied volatility. However, on the market option may be misvalued. In this case, the call option with 105 exercise price has higher volatility than option with exercise price $95 and $100. It's supposed to be one number, right? So the volatility of 25% could be undervalued, or 30% for 105 call is overvalued, but it should be the same number. So here it seems that 105 call, the call with $105 of exercise price, tend to be overvalued, and 95 call, 100 call tend to be undervalued. All right, so what can you do as an investor? You buy low, sell high. You buy low, sell high. What is high? 30% is high. What is low? 25% is low. So you buy low, which is either 95 or 100 call, and sell high, 105 call. So you buy either 95 or 100 call, and right means sell 105 call. So answer is C. Number 43. According to protocol parity theorem, the payoffs associated with ownership of call option can be replicated by doing what? So C minus P equals stop price minus the present value of exercise price. So in order to replicate a call, so on the left is a C, on the right that is a S0 minus PV of exercise price plus put call plus P. That means you buy stock and put option, and also you borrow the present value of the exercise price. Right? So here answer is B. You buy stock, borrowing present value exercise price, and buy a put. That will replicate the call option based on put call parity. Last one, 44. You are considering purchasing a put option. I'll start with the kind of price $33, exercise price $35, price of corresponding call option $2.25. According to protocol parity, if risk-free rate 4% and 90 days until expiration, the value of put option should equal to what? And here, once again, you apply put call parity, and you need to calculate put option. Put option equals call option minus stop price plus the present value of the exercise price. So call option price $2.25 minus stop price $33, and X here plus X is the exercise price $35, and then you take the present value based on continuous compounding, and E minus 0.04, that's risk-free rate, times 90 days left divided by 365. There will be the T in that option. That will give you $3.91 of put option price. Number 45, the stop price is $43, risk-free rate 10%, call option with exercise price of $40, and expires 6 months from now is $5. Put option put option on the same stock with exercise $40 and 6 months expiration date from now should be worth what? So here it's a similar questions. You utilize protocol parity, right? You know call option price, stop price, exercise price, and also you know how to calculate its present value. So it will give you it will give you 5 cents value of that put option. Number 46. It's a very similar question. It just asks you the stop price given call put price and other variables such as T and risk-free rate. And here you apply equation of protocol parity to solve for stop price. Answer is A. I'll leave the calculation to you guys to make sure you understand how to use this protocol parity. Number 47. You calculate Black-Scholes form value of call option as $3.50. Does not pay dividends, but the actual call price is $3.75. The most likely explanation for discrepancy is that either option is overvalue, undervalue, or the volatility you put into model is too high or too low. Alright, so here you compare your price with the market price. Right, one potential reason for the difference is your estimation of volatility is lower than what the market believes. So your volatility input is too low, right? So that leaves either A or B the right answers. Then you look at if option is either overvalued or undervalued, right? In this case, market price is higher than the price that you think is right. Therefore, it could be overvalued and should be short sell or be written. Right? So answer is A. Answer is A. Number 48. Right, last question. And in this case, you apply the same principle of protocol parity. Right? The stop price is $65, standard deviation 30%. 3 months call puts with exercise price of $60 available. The call has premium $7.27. Put option price of $1.10, given 5% risk-free rate, and a theoretical value of $1.525. And you believe that puts are undervalued. Right? Because on the market is $1.10, but based on protocol parity, it should equal to $1.525. So in this case, you believe that puts are undervalued. So in this case, the protocol parity is violated. It asks you to explore the way to capture that risk-free profit. Right? So how to do arbitrage in this case? Well, you look at this protocol parity. On the left, that is C minus P, call option minus put option. Right? It equals $6.17. Then you look at the right side. Stop price minus present value of the exercise price, $5.75. And the difference is $1.52. And this $1.52 or 1.52 million or 1.52 billion is your risk-free profit. Right? How to capture that? So here you apply arbitrage strategy. How arbitrage strategy requires you to take long short position, right? Simultaneously, you buy low, sell high simultaneously. So here, where's the low? Stop price minus, right? Present value of strike price. You buy on this side and you sell C minus P. So sell C minus P means you sell a call option, and minus P means you buy a put option. That's what you do. Right? On the left side. On the right side, you want to buy. Right? And buy is 0 minus X time, the present value X means that you buy stock, right? And also you borrow money. You borrow the present value of the exercise price. Right? So once again, you sell a car, you buy a put. You buy a stock and borrow the present value of exercise price. So the answer is C. So this is how arbitrage works if you find that a protocol parity is violated. When it's violated, don't panic. Don't panic because it's a great opportunity for you to take the free lunch on the financial market. That is arbitrage. So that concludes our chapter of options.